Saudi Arabia has terminated the 50-year petrodollar agreement and begun accepting yuan, euros, rupees, and BRICS settlement units for oil. 12 OPEC-adjacent nations are watching the exits. China has accelerated its yuan-denominated commodity infrastructure. The G7 issued 11 words. The Federal Reserve convened its fourth unscheduled board meeting in 110 years. The dollar index fell 4.3%, the largest single-session drop since 1971. Gold moved $340 in 90 minutes. U.S. 10-year yield spiked 110 basis points. $3 trillion in S&P market cap disappeared before the closing bell. And Ray Dalio, 50 years, never an emergency statement, used the word terminal. That is where we stand. Now the questions that no one has answers to yet. Will the dollar lose its reserve status completely, partially, or not at all? And does the difference between those outcomes matter, if the credibility of its permanence is already gone? If the U.S. Treasury can no longer fund its deficits at the rates made possible by global dollar demand, what gets cut? Social Security? Defense? Medicare? And what does any of those answers do to the political stability of the country that still holds more nuclear weapons than any other on Earth? When the reserve currency of the global economy loses its structural anchor, what becomes the risk-free rate? And if there is no risk-free rate, what happens to every financial model, every insurance calculation, every pension projection that was built on one? And when the principle that dollar dominance is permanent dies in a Tuesday morning Riyadh press release, what stops every nation with dollar-denominated debt and a strategic grievance from drawing the same conclusion, that the architecture can be renegotiated? What stops them? What stops all of them? There is one final thing to understand about what happened today. China didn't end the petrodollar. Russia didn't end it. No adversary on earth could have ended it by force. The world that follows dollar hegemony will not be a world without a reserve currency. It will be a world with several, each regional, each partial, each more expensive to transact in than the frictionless dollar system it replaces. The Chinese yuan, constrained by capital controls and a non-convertible financial system. The euro, perpetually fragile, still carrying the unresolved contradictions of a monetary union without a fiscal union. Gold, the oldest hedge and the slowest. The winners in this transition are those who held tangible assets, commodities, land, productive infrastructure, in the decades before the transition arrived. The losers are those who held financial assets priced in the currency whose structural support just disappeared. The losers, in concrete terms, are the American middle class. The defined benefit pension that was never fully funded because Treasury yields made the math work. The 401k that assumed equity valuations priced in stable long-term rates. The adjustable rate mortgage that assumed the Fed could manage inflation within a bandwidth that dollar reserve status made possible. The losers are the nations that built their debt structures in dollars because dollars were the cheapest, most liquid, most globally accepted form of long-term borrowing, and who now face a repricing of that debt in a world where the currency it's denominated in is less trusted than it was yesterday. And the deepest irony, the one that will be written about for a generation, is that the petrodollar agreement was constructed in 1974 by Henry Kissinger precisely to prevent this scenario. The United States created a system so effective, so total, so apparently permanent, that it stopped preparing for the day it might end. The day it might end was today. Summary cascade plus final existential questions plus closing thesis. Fast recaps, slow questions, single devastating final line. Here's where we stand. An arrangement through which the United States converted its post-war military and economic dominance into a permanent structural advantage that operated silently, invisibly, and automatically through the price of oil. Every time a nation bought oil, and every nation on earth buys oil, it needed dollars. To hold dollars, it needed to maintain a relationship with the American financial system. To maintain that relationship, it needed to hold American Treasury bonds. To hold American Treasury bonds, it needed to accept American monetary policy. To accept American monetary policy, it needed to accept, however reluctantly, some degree of American strategic alignment. It was not coercion. It was architecture. Nobody was forced. The dollar was simply the only door in the room. Strip that architecture away, and the four principles that underpin the post-war global order, become negotiable for the first time in 50 years. That reserve currencies are determined by markets, not military power. That commodity pricing is a neutral, apolitical mechanism. That debtor nations cannot weaponize their debt to compel their creditors. And that economic interdependence makes the cost of challenging American hegemony prohibitive. Saudi Arabia just revealed that every one of those principles was a choice, not a law. And having revealed it, every other nation on earth now knows the same thing. And here is the cruelest insight of all. Even if Saudi Arabia reverses the decision tomorrow, announces it was a miscalculation, a negotiating tactic, a temporary deviation, the world will never believe the petrodollar agreement is permanent again. Because it wasn't. Because Saudi Arabia just proved it wasn't. You can renegotiate a petrodollar agreement. You cannot renegotiate the knowledge that it was always renegotiable. What replaces the order? Foreboding inevitability, paint the post-dollar world. So where does this leave us? In Washington, the Treasury Secretary called an emergency briefing that lasted 6 hours and produced no public statement. The Federal Reserve convened an unscheduled board meeting, only the fourth such meeting in the Fed's 110-year history. The chairs of the Senate Banking Committee and the House Financial Services Committee issued competing statements that agreed on one thing and one thing only: this is serious. The National Security Council met 3 times before midnight. In Phoenix, Arizona, the manager of one of the country's largest dollar-cost averaging retirement platforms, overseeing $47 billion in 401k assets, told Reuters, "Every portfolio we manage was built on the assumption that dollar-denominated bonds were the risk-free benchmark. If that assumption breaks, we don't have an alternative model. We have a problem." In Houston, energy traders began repricing long-term oil contracts denominated in yuan for the first time in their professional lives, not because they wanted to, but because 3 of their largest Saudi counterparties were no longer accepting dollars for delivery contracts beyond 30 days. In suburban Chicago, a financial planner named Karen Walters told a local news crew what she would tell her clients on Monday morning. "I don't have an answer. And I've been doing this for 22 years. That is the story. Not the Treasury yields. Not the OPEC emergency session. Not the G7's 11 words. The story is Karen Walters, 22 years of professional expertise, sitting across from a retired couple and not having an answer. This is every savings account. Every pension. Every mortgage rate. Every price at every register in every store in America. Philosophical reckoning. What was the petrodollar, really? Essay mode, slow, deliberate, intellectual grief. Now what happened today is the part of this story that matters most. The petrodollar agreement was never, at its core, a financial instrument. It was a statement of power. In terrain that no living financial professional has ever navigated. The room went quiet. It tends to, when the man who saw 2008 coming says the word terminal. Market collapse data. Staccato data points, ground the abstract in hard numbers. Here is what the market said within 4 hours of the announcement. The US dollar index fell 4.3%, the largest single-session decline since the Nixon shock of 1971, when the US abandoned the gold standard. Not a correction. A repricing. Gold surged $340 an ounce in 90 minutes. The fastest move in the gold market in recorded history. The world's oldest hedge against currency debasement told you everything the central banks were not saying out loud. U.S. 10-year Treasury yields spiked 110 basis points, a move so violent that 3 primary dealers halted their market-making functions simultaneously. When the people whose job is to buy and sell American debt stop doing their job, it is not because the math got complicated. It is because the math stopped working. Brent crude, priced in dollars, rose 18% in a single session, not because oil became scarcer, but because the currency used to price it became less trusted. The S&P 500 lost $3.1 trillion in market capitalization before the closing bell. Not because corporate earnings changed. Because every model used to value those earnings assumed a stable dollar, a stable treasury yield, and a stable cost of capital. All three assumptions failed simultaneously. This isn't a correction. It isn't a bear market. It is a repricing of the foundational assumption on which the entire post-war financial architecture was built. And here is the question that no one on CNBC was asking, because no one on CNBC has a model for the answer. If the dollar loses its reserve status, partially, gradually, structurally, who funds the American deficit? And at what price? Domestic political fallout. Zoom in, global to local, abstract to personal. The civilizational anchor, slow, funereal, devastating. And then Ray Dalio issued his emergency statement. Not a market update. Not a hedge fund letter. An emergency statement, the first document in Dalio's 50-year career issued outside the context of investment advice. His office described it simply as a statement of factual record for the historical moment. In 50 years of studying the rise and fall of reserve currencies, from the Dutch guilder to the British pound to the dollar, Dalio had described a pattern he called the big cycle. Empires rise through productivity and savings, accumulate debt, debase their currencies, and eventually lose the reserve status that allowed them to run the debts that debased the currency. The cycle takes decades. It is never stopped. It is only accelerated or slowed. In the statement, Dalio argued that the Petrodollar agreement had been the single most powerful structural instrument extending the dollar's reserve life past what its debt fundamentals would otherwise support. Remove it, and the underlying debt mathematics, $34 trillion in federal debt, a current account deficit approaching 4% of GDP, annual interest payments now exceeding the entire U.S. defense budget, become impossible to service without a degree of money printing that is, in his word, terminal. He argued that every asset on earth, every equity, every bond, every real estate market, every pension fund, was priced under a model that assumed this structural support would persist indefinitely. That model is now wrong. Dalio said it plainly. Reserve currencies decline gradually, then collapse suddenly. We are in the suddenly. He did not recommend any specific action. He did not predict a timeline. He said only that every investor, every institution, every government that had not stress-tested its portfolio against a world in which the dollar is no longer the singular reserve currency was, as of this morning, operating without a map.
Needed American Treasury bonds. Every nation that needed Treasury bonds needed to maintain a relationship with Washington. And Washington, in turn, could run deficits no other nation on earth could survive, because the rest of the world had no choice but to fund them. Pull the anchor bolt, and the cables don't snap immediately. The bridge doesn't fall in a single afternoon, but the math that held it together stops working, and there is no version of this where the bridge does not eventually come down. Saudi Arabia just pulled the anchor bolt. The dollar was never just a currency. It was the proof that American military and economic dominance could be converted into a permanent structural advantage that outlasted every war, every recession, every political crisis the world threw at it. That proof just expired. G7 and Western alliance fracture, first-order cascade, credibility collapse in real time. The G7 emergency call lasted 4 hours and produced a joint statement of 11 words. We are monitoring the situation and coordinating a measured response. 11 words, 4 hours, no specifics, no timeline, no mechanism. Every currency trader on earth read that statement the same way. The G7 has no answer. France and Germany privately signaled they would not join any retaliatory sanctions package targeting Saudi Arabia, because France and Germany buy Saudi oil, and Europe cannot afford a second energy shock after Ukraine. The UK, still navigating post-Brexit trade realities, declined to prejudge the situation. Canada issued a statement that used the word concern 4 times in 3 paragraphs and proposed exactly nothing. Japan's finance minister said what no one else in the room would say out loud. If the dollar's reserve status is structurally threatened, the framework of every G7 fiscal agreement made in the last 40 years requires immediate renegotiation. Translation: the alliance that built the post-war financial order cannot agree on how to defend it, because half the members of that alliance have already decided that defending it costs more than losing it. The hegemony was never just held by carrier groups and treasury bonds. It was held by the universal belief that every major economy needed the dollar more than the dollar needed them. Saudi Arabia just tested that belief. The G7 just answered the test with 11 words. The predators move: China, Russia, Iran, and the opportunists' rapid-fire cascade. Every rival on Earth moves within 72 hours. The security guard collapses, and every door in the building swings open. China, which has spent 15 years building the infrastructure for a post-dollar commodity trading system, constructing the cross-border interbank payment system as a dollar alternative, stockpiling gold at a pace not seen since the Bretton Woods era, announced it would fast-track yuan-denominated oil futures contracts with all willing partners. Beijing did not cause this crisis. It had simply been waiting patiently for this exact moment. Russia, under the weight of the most comprehensive sanctions regime in modern history, announced the immediate reopening of its oil exchange for non-dollar denominated trade, calling the Saudi announcement the correction of a historical injustice. Every sanctioned economy on Earth heard that and understood. The enforcement mechanism of dollar-denominated sanctions just became a great deal weaker. Iran, which has operated outside the dollar system by force for 40 years, filed a formal application for full BRICS membership within 3 hours of the Saudi announcement. The symbolism was deliberate and total. Brazil, the world's largest agricultural exporter, announced it was actively evaluating yuan-denominated commodity contracts. If Brazilian soybeans start trading in yuan, the dollar loses its grip on the second pillar of global commodity pricing. India, already conducting rupee-ruble oil trades with Russia, expanded its non-dollar settlement framework with 4 Gulf states simultaneously. New Delhi is not an adversary of Washington. It is simply acting in its own interest. And its interest is no longer automatically aligned with dollar hegemony. The BRICS bloc, Brazil, Russia, India, China, South Africa, plus 6 newly admitted members, announced an emergency summit in 48 hours to accelerate the launch of a BRICS settlement currency. A project dismissed as fantasy by most Western economists 18 months ago now has the world's largest oil exporter as its most credible advocate. Venezuela called the development the liberation of the Global South. Nigeria began non-dollar contract negotiations with 3 Asian partners before markets closed. Argentina, drowning in dollar-denominated debt, announced a complete review of its reserve strategy. Every nation on Earth with a grievance against dollar-denominated financial dependency just got handed a permission slip. Ray Dalio's emergency statement. Out of every financial assumption Wall Street has made for the last 50 years, out of every model every central bank on Earth built its reserve strategy around, out of every trade denominated in dollars, every oil contract settled in dollars, every treasury bond issued on the premise that the dollar would always be the world's reserve currency, out of all of it, Saudi Arabia walked away on a Tuesday morning without a press conference, without a formal announcement to the IMF, without a single phone call to the Treasury Secretary, and changed the architecture of the global economy in a way that will not be undone in your lifetime. The Kingdom of Saudi Arabia formally announced the termination of its 50-year petrodollar agreement with the United States. The agreement that made the dollar the only currency in which global oil was priced. The agreement that gave Washington the ability to print money the rest of the world was forced to hold. The agreement that funded every American deficit, every American war, every American entitlement program since 1974. It is over. Let that sink in. Ray Dalio, the founder of Bridgewater Associates, the man who predicted the 2008 financial crisis, the architect of the big cycle theory of reserve currency collapse, issued what his office described as a non-investment emergency statement. Not a market update, not a quarterly letter, an emergency statement, the first of its kind in his 50-year career. We are going to walk through exactly what Dalio said, exactly why it matters, and exactly what the end of petrodollar dominance means for every dollar in your bank account, your retirement fund, your mortgage, and the price of everything you will buy for the rest of your life. Subscribe now, because this story is moving by the hour, and if you miss the next update, you will be the last person in the room to understand what just happened to your money. The termination order. What actually happened? Granular breakdown across 5 dimensions: maritime, financial, diplomatic, military, technological. Here's what Saudi Arabia did. The currency dimension. Riyadh announced it would immediately begin accepting Chinese yuan, euros, Indian rupees, and a new BRICS settlement unit for all future oil contracts. The first time since 1974 that Saudi crude has been priced in anything other than US dollars. The daily volume of dollar-denominated oil transactions that just evaporated. $13 billion. Every single day. Gone. The reserve dimension. The Saudi Sovereign Wealth Fund, $925 billion in assets, announced a phased reduction of U.S. Treasury holdings beginning within 30 days. When the world's largest oil exporter starts selling American debt, every other nation holding dollar reserves does the math and reaches the same conclusion. The exit door is narrower than the entrance, the diplomatic dimension. Within 6 hours of the announcement, 12 OPEC and OPEC-adjacent nations issued statements of supportive review, diplomatic language that every currency trader alive translated instantly. They're watching, and if Saudi Arabia survives the first wave of American retaliation, they follow. The petrodollar wasn't just a Saudi agreement. It was the cornerstone of an entire global architecture of dollar dependency. 47 nations price their sovereign debt in dollars. 39 nations hold the majority of their foreign reserves in dollars. That architecture now has a crack running through its foundation. The military dimension. The U.S. Fifth Fleet, headquartered in Bahrain, 12 nautical miles from Saudi territorial waters, has not been asked to leave. It has simply been informed that its port access agreement is under bilateral review. Washington has 48 hours to respond to a renegotiation demand it never anticipated and has no playbook for. The nuclear dimension. Saudi Arabia reactivated its dormant civilian nuclear cooperation agreement with China, the same agreement the Biden administration spent 3 years trying to replace with an American alternative. The message is not subtle. Riyadh no longer needs Washington's nuclear umbrella as a deterrent against choosing its own economic partners. Think about that for a moment. The foundation stone metaphor, central explanatory metaphor, full structural elaboration before application. Imagine the global financial system as a suspension bridge, one of the great ones, the kind that spans a mile of open water with nothing underneath but the math holding it together. The petrodollar was not a cable on that bridge. It was not a support beam. It was the anchor bolt, the single point driven into bedrock on the American side that every other cable